It is Monday, February 9th, 2026, and while you were sleeping, while you were focused on the weekend, something extraordinary has been unfolding in the precious metals markets in the Canadian economy. The silver price in Canadian dollars has been trading around 196 per troy ounce, and that number represents just the tip of an iceberg that's reshaping everything we thought we knew about North American trade, monetary policy, and the future of safe haven assets. Just days ago, on February 5th, 2026, Bank of Canada, Governor Tiff Millam stood before the Empire Club of Canada and delivered what can only be described as a bombshell statement. He didn't mince words, he didn't soften the blow. He said it plainly. Open trade with the United States is over. Let that sink in for a moment. Not under review. Not being renegotiated. Over. Finished. Done. This is a governor of a G7 central bank telling the world that the era of free trade between Canada and the United States, the world's longest undefended border, the foundation of modern North American prosperity, has come to an end. What does this mean for silver investors? What does it mean for anyone holding Canadian dollars? What does it mean for you? We're going to break down every angle of this situation, and I'm going to show you exactly why the price action we're seeing in silver, the chaos in the loonie, and the structural changes happening in the Canadian economy are all connected in ways that most mainstream analysts are completely missing. Before we dive deeper, let me address the recent volatility head-on. January 2026 will go down in history as one of the most volatile months for precious metals ever recorded. Silver started the year around $70 per ounce in US dollar terms, then exploded to an all-time nominal high of approximately $121 per ounce on January 29th. That's a 73% gain in less than a month. Then came Friday, January 30th, a day that veteran traders are calling the Friday flash crash. In less than 30 hours, silver plummeted from $121 to an intraday low just below $75, a brutal 38% correction that represented the worst single-day performance for silver since 1980. This wasn't just a correction. This was a liquidation event. The announcement of Kevin Warsh as the next Federal Reserve Chair triggered a market interpretation that we were pivoting toward aggressive monetary tightening, a hard money stance that sent leveraged positions into a death spiral. Open interest collapsed. Margin calls cascaded through the system. Billions in paper wealth evaporated in what some traders are calling a 30-unit crime scene. But here's what you need to understand. The fundamentals that drove silver to 121 haven't disappeared. They've actually intensified. After the first 4 minutes of diving into these markets, I need to ask you something important. If you value this kind of original research, if you want to help push back against the copycat channels that just regurgitate press releases without doing the actual work, I need you to hit that subscribe button right now. I'm bringing you daily updates on silver markets, Canadian dollar movements, and the geopolitical shifts that mainstream media won't cover properly. And if you really want to show your support and help the algorithm understand you're with us, drop a comment saying, "I am with Silver Guy right now." Your engagement helps us reach more people who need this information. Now, let's get back to the bombshell developments. Governor Milham's statement wasn't made in isolation. It came during a speech titled Structural Change, Canada at a Crossroads, where he laid out the stark reality facing the Canadian economy. U.S. tariffs, which initially targeted specific sectors like steel and aluminum, have metastasized into something far more damaging. The uncertainty around trade policy has caused Canadian businesses to postpone expansions, approach new U.S. contracts with extreme caution, and fundamentally rethink their entire supply chain strategies. The Bank of Canada's own projections show that by the end of 2026, Canada's GDP will be approximately 1.5% lower than projected in January 2025, with roughly half of that shortfall coming from reduced potential output and the rest from increased excess supply. What does this mean in practical terms? It means the Canadian economy is being forced into a painful restructuring. Businesses are redirecting trade away from the United States, seeking new markets, building new supply chains. Workers and capital are shifting from industries hit hardest by tariffs toward other sectors. This transition, McLemore, will be challenging. Growth will be modest at best. The Bank of Canada projects GDP growth of just 1.1% in 2026 and 1.5% in 2027. These aren't recession numbers, but they're anemic, especially for an economy trying to absorb the structural damage of a trade war. Now, let's connect this to what's happening with the Canadian dollar. The loonie has been on a roller coaster ride. In late January, USDC CAD strengthened past 1.36, meaning it took more than 1.36 Canadian dollars to buy $1 US. This represented a retreat from 16-month highs for the Canadian currency. The weakness came as domestic growth signals deteriorated. GDP was flat in November, and goods-producing industries contracted for the third time in 4 months, led by ongoing manufacturing weakness. At the same time, oil prices, which traditionally support the loonie, given Canada's status as a major energy exporter, have been sliding. Crude has fallen toward the low 60s per barrel amid easing geopolitical risks tied to US-Iran negotiations, weakening Canada's terms of trade. But here's where it gets interesting for silver investors. The weakness in the Canadian dollar actually amplifies the silver price in CAD terms. When we see silver trading at around $778 USD per ounce in spot markets as of early February, that translates to approximately $16 per troy ounce when you factor in the exchange rate. This is a critical point that many investors miss. If you're holding silver in Canada, you're getting a double benefit from both the underlying strength in the silver price and the relative weakness of the Canadian dollar against other major currencies. Let's talk about the silver market fundamentals that are driving this historic price action. Silver's role as both an industrial metal and a monetary metal has created what analysts are calling a perfect storm. On the industrial side, demand has exploded. Electric vehicles, solar panels, advanced batteries, semiconductors. All of these technologies require silver, and specifically, they require silver's unmatched electrical conductivity. There's no easy substitute for many of these applications. As EV adoption accelerates and renewable energy investment continues globally, this isn't cyclical demand. This is structural permanent demand growth. On the supply side, we have a crisis brewing. Silver production has struggled to keep pace for years because most silver is mined as a byproduct of other metals like copper, lead, and gold. This means that even when silver prices surge, production can't be ramped up quickly. You can't just open a pure silver mine overnight. The supply deficit is real, it's measurable, and it's getting worse. China's introduction of stricter export controls on silver effective January 1st, 2026 has only exacerbated this situation. Now only state-approved companies meeting high production and financial criteria are allowed to export silver from China, effectively excluding many small and mid-sized exporters from the market. This has squeezed international availability and pushed prices higher. Add to this the monetary aspect. Silver has been reclaiming its status as a monetary metal, not just an industrial commodity. The gold-silver ratio, which historically hovered around 80.1, meaning it took 80 ounces of silver to equal the value of 1 ounce of gold, crashed toward 30.1 during the peak of January's rally. This compression suggests that investors are increasingly viewing silver as a primary safe haven asset in a world growing wary of centralized banking risks and currency debasement. The Canadian context makes this even more compelling, with Governor Milham explicitly stating that open trade with the United States is over. Canadian investors and businesses are looking for ways to protect their wealth from the structural changes ahead. Silver, with its dual role as an industrial necessity and a store of value, becomes an obvious choice. It's liquid, it's globally recognized, and unlike fiat currencies, it can't be printed into oblivion. Now, let's address the elephant in the room, the volatility. Is silver too volatile to be a serious investment? Here's my take, and I want to be completely honest with you. Yes, silver is volatile. It's inherently more volatile than gold because it's a smaller market with less liquidity. The January crash from $121 to $75 proves that leverage and speculation can drive wild price swings. But here's what the crash also proved. There's massive underlying physical demand. When prices crashed, we didn't see a collapse in physical buying. In fact, physical dealers reported that customers were lining up to buy the dip. Premiums on physical silver coins and bars barely budged during the crash because the smart money understands that what we witnessed was a paper market liquidation, not a fundamental breakdown in the silver thesis. The technical support that's emerged around 808.085 USD per ounce, which translates to roughly $110–115 at current exchange rates, suggests that this range may represent the new floor for silver prices. Multiple analysts, including those from Goldman Sachs and Bank of America, have maintained bullish targets for precious metals through 2026. Goldman has a $5 to $400 price target for gold by year end. For Canadian investors specifically, there's another factor to consider: the Bank of Canada's monetary policy stance. After cutting rates from a peak of 5% down to the current 2.25%, through 9 consecutive cuts from summer 2024 through late 2025, the BOC has now paused. Governor Milham has made it clear that uncertainty remains elevated and that the bank is prepared to respond if the outlook changes. But here's the key. The BOC ran ahead of the Federal Reserve on rate cutting and now finds itself with limited room to maneuver. This means that if economic conditions deteriorate further due to the trade situation, the bank's ability to provide meaningful stimulus is constrained. This creates an environment where real interest rates, the nominal interest rate minus inflation, could remain suppressed for an extended period. Suppressed real rates are historically bullish for precious metals because they reduce the opportunity cost of holding non-yielding assets like silver. When you can't earn a meaningful real return in cash or bonds, hard assets become more attractive. Let me give you some concrete numbers to illustrate the magnitude of what we're seeing. As of February 7, 2026, silver in Canadian dollars was trading at $16.36 per troy or $342 per gram. This represented an increase of 14.71 or about 16% compared to the previous day's close. In the past year, silver rose by approximately 134% in CAD terms. Over 5 years, it more than doubled up over 205%. Over the past decade, silver prices in Canadian dollars nearly tripled. These aren't small moves. This is a fundamental repricing of the metal. The high point for silver per ounce during 2026 was $158.18 on January 28th, just before the crash. The low point was $94.54 on February 5th. As of now, we're trading roughly in the middle of that range, but with a clear bias toward the upside given the fundamental drivers we've discussed. What about the mining companies? This is where things get really interesting for investors. Looking beyond just physical metal, primary silver miners like Pan American Silver and First Majestic Silver saw their share prices double in a matter of weeks during January's rally as profit margins expanded exponentially. Streaming companies like Wheat and Precious Metals, which have contractual rights to purchase silver at fixed prices from producing mines, have seen similar gains. The leverage that mining companies provide to the underlying metal price is significant, though it comes with company-specific risks that direct metal ownership doesn't have. For those concerned about the trade situation between Canada and the United States, silver mining actually provides an interesting hedge. Many Canadian silver miners operate internationally with assets in Mexico, South America, and other jurisdictions. This geographic diversification means their revenues aren't entirely dependent on North American trade flows. At the same time, their costs are often in local currencies that may be weaker than the Canadian dollar, providing a natural margin boost. Let's zoom out and look at the bigger geopolitical picture, because this is crucial for understanding where silver prices might go from here. Governor Mellihem's statement about the end of open trade with the United States aren't happening in a vacuum. The entire global trade architecture is being restructured. The U.S.-Mexico-Canada Free Trade Agreement USMCA is up for review in July 2026, and President Trump, who personally negotiated the deal during his first term, has expressed consistent dissatisfaction with it. This creates massive uncertainty for businesses on both sides of the border. But it's not just about Canada and the United States. Global trade patterns are shifting. China's growing influence, the formation of BRICS payment systems as alternatives to the US dollar-dominated SWIFT network, Europe's efforts to achieve strategic autonomy. All of these trends point toward a more fragmented, multipolar world. In such a world, countries and individuals alike seek stores of value that aren't tied to any single government's promises. Gold and silver have served this role for thousands of years, and they're being rediscovered by a new generation of investors who have watched central banks around the world engage in unprecedented monetary expansion. The zombie bank crisis in China that emerged in late 2025 and early 2026 has exposed the fragility of the global financial architecture. When institutions as large as Bank of China or China Construction Bank are perceived as potentially unstable, the resulting capital flight doesn't stay within borders. It destabilizes global liquidity and drives investors toward assets they can physically hold. This is part of why we saw such aggressive buying in precious metals in January, and why the correction, as violent as it was, didn't fundamentally change the bull market thesis. For Canadian investors and businesses specifically, there's a strategic consideration here. If open trade with the United States truly is over, as Governor Melliham stated, then Canadian economic growth will have to come from other sources. Diversifying trade to Europe, Asia, and other markets will take time. Expanding the internal Canadian market can help, but Canada's population of about 40 million limits domestic consumption compared to the U.S. market of 330 million. This means years of below potential growth while the economy restructures. In such an environment, having a portion of your wealth in assets that maintain purchasing power globally becomes not just prudent, but essential. Silver's advantage over gold for many investors is its lower price point per ounce, at $106 per ounce versus gold's price over $6,000 per ounce. Silver is more accessible for regular investors looking to dollar-cost average into precious metals. A Canadian investor can buy meaningful amounts of silver with a few hundred, whereas a similar investment in gold buys a fraction of an ounce. This accessibility has historically made silver the people's money. And in times of economic uncertainty, retail demand for silver can be enormous. Looking ahead to the rest of 2026 and beyond, several key factors will determine where silver prices go from here. First, Federal Reserve policy under new Chair Kevin Warsh will be critical. If Warsh proves to be as hawkish as markets initially feared, pushing real interest rates significantly higher, that could pressure all precious metals in the short term. However, the U.S. fiscal situation with debt over $35 trillion and rising makes sustained high rates difficult without triggering a debt crisis. This argues for an eventual return to easier monetary policy regardless of who chairs the Fed. Second, the resolution or escalation of U.S.-Canada trade tensions will matter enormously for the Canadian dollar and thus for CAD-denominated silver prices. If the USMCA review in July results in even more restrictive trade terms, we could see further weakness in the loonie amplifying silver gains for Canadian holders. Conversely, any surprising rapprochement could strengthen the Canadian dollar and reduce the CAD price of silver even if USD prices remain stable. Third, the industrial demand picture for silver will evolve with the pace of the energy transition and technology adoption. China's continued build-out of solar capacity alone accounts for hundreds of millions of ounces of annual silver demand. The growth of electric vehicles globally is adding to this. Any acceleration in these trends would tighten the supply-demand balance further. Fourth, geopolitical risks remain elevated. Tensions between the U.S. and Iran, the ongoing Russia-Ukraine situation, the potential for conflict over Taiwan, all of these create a safe haven demand for precious metals. Silver, as the more volatile precious metal, tends to see exaggerated moves during geopolitical stress. So, where does this leave us today, February 9th, 2026? Now, silver in Canadian dollars is trading around 106, having recovered from the February 5th low of 94.54, but still well below the January 28th high of 158.18. The Canadian dollar is trading around 1.367 against the US dollar, reflecting ongoing concerns about domestic growth and the trade situation. Governor Melham has made it crystal clear that the era of free trade with the United States is over, setting the stage for years of structural economic adjustment in Canada. For investors, this environment presents both challenges and opportunities. The volatility we've seen is likely to continue. Silver is not for the faint of heart. Anyone allocating capital to silver needs to understand that 20 to 30% corrections can happen at any time, as we just witnessed. Position sizing is critical. This should be a portion of your portfolio that you can afford to be volatile, not your rent money or emergency fund. But for those who can handle the volatility, the fundamental case for silver remains compelling. The supply deficit is real, industrial demand is structural and growing. Monetary policies globally remain accommodative by historical standards. The Canadian context adds an additional layer with currency weakness, potentially amplifying returns for domestic holders, and the breakdown of traditional trade relationships driving demand for alternative stores of value. My view, and I want to be completely transparent about this being just one analyst's opinion, is that we're in the early to middle stages of a silver bull market that could run for years. The January crash to $75 may have represented a significant low, with the next major test being whether we can reclaim and hold above 100 USD per ounce, or roughly 135 along $140 at current exchange rates. If we can establish that level as support, the path toward new all-time highs becomes viable. If we fail and break below the $75 USD level, we'd need to reassess the bull case. The sources I've used for this analysis include data from multiple precious metals, pricing services, Bank of Canada official publications, including Governor MLM's February 5th speech and the January 2026 Monetary Policy Report analysis for major financial institutions, including Goldman Sachs, Bank of America, and CIBC, and reporting from financial news services covering the January volatility. All of this information is publicly available, and I encourage you to do your own research and verify everything I've presented. What I'm not going to do is tell you to buy or sell anything. I'm not a financial advisor, and I'm not your financial advisor. What I am is someone who's deeply researched these markets and who's sharing that research with you so you can make your own informed decisions. The silver market is complex, interconnected with currency markets, monetary policy, industrial demand, and geopolitical developments. Understanding these connections gives you an edge that most market participants don't have, that we're living through a remarkable period of structural change in the global economy, and particularly in the North American economy. When the governor of the Bank of Canada says that open trade with the United States is over, that's not just a headline. It's a fundamental shift that will have ramifications for decades. How you position your portfolio for this shift could make an enormous difference to your financial future. Silver, with its unique properties as both an industrial necessity and a monetary metal, deserves serious consideration in that positioning. The price at $16 today may look like either a bargain or expensive, depending on what unfolds over the coming months and years. But what's certain is that we are no longer in the old world of stable trade relationships and predictable monetary policy. Welcome to the new paradigm. Stay informed, stay prepared, and I'll see you in the next update.